Welcome to The Business Behind Your Business, the podcast where we delve into the financial strategies and insights that drive success for small and medium-sized business owners. I'm your host, Paul Sweeney, and in each episode we bring you expert guests who share practical advice, real-world experiences, and actionable tips to empower you on your business journey. Whether you're a seasoned entrepreneur or just starting out, get ready to uncover the secrets to success and gain valuable insights into the business behind your business. Most business owners, they're being told that the safest way to build wealth is property. But what if buying the right business, funding it properly and improving it deliberately is going to deliver a far better return for you with more control over your destiny, your future? Well, today we're going to unpack how business acquisitions really work and what banks are looking for so you can actually turn a business into a multiplier, a cash multiplying asset that's going to fund your long-term future. So welcome back to the Business Behind Your Business podcast. I'm your host, Paul Sweeney, and this is a show where we unpack what actually drives value, growth, and freedom behind successful businesses, just like yours. Today's conversation is all about acquisitions. Now, you might be thinking, I'm already a business owner. Why do I need to know about acquisitions? Well, let's have a dive into it because we've talked about vertical integration. We've talked about actually multiplying your skill set and your offering. So let's have a closer look, not just from a perspective of theory, but also look at some real world situations, talking about lending and also the cash flow angle that most businesses don't see until it's way too late or they just ignore. So what are we going to learn today? Well, today we are going to learn why buying a business can outperform property or other types of investments when it's structured and funded correctly. We're going to find out what the banks and the lenders are really looking for when you're acquiring a business and why you can make that whole process of funding your new business so much easier. What are the red flags that you need to avoid? And we're also going to look at how you can get ready to buy a business so that when you're not scrambling for approvals at the last minute and risking missing out on that opportunity at the worst possible time. So our guest today, is Sidd Bahree. Sidd's the founder of Express Finance, spent years inside the banking system, understands how it works. He's been working with business owners across Australia on a number of complex commercial finance deals, including a lot of business acquisitions. Now, Sidd and I, we've actually crossed paths through the Dent Global workshops, the Key Person of Influence. We've connected offline. We've got a common passion here for helping business owners grow and be successful and also make sure that they've got the right funding in place so that they can actually achieve success. And when we were talking offline, I thought that Sidd's perspective here would be invaluable to you. And we're going to untap a lot more of what Sidd has to say. So, Sidd, welcome to the Business Behind Your Business podcast.
Thank you, Paul. Thanks for having me.
Look, it's great to have you. And look, we've had some conversations leading in from when we first met in the debt workshops. And we're sort of looking at these ideas of why do so many people avoid the idea of buying a business? What are they afraid of? Or what are the myths that they've been told about why you shouldn't actually go into business? And, you've got a different perspective to what I hear from a lot of finance brokers and financial advisors who are very much focused on property and shares. Why is buying a business a serious consideration?
Yeah, so I think building a business is really important in this day and age for two reasons. Firstly, right now with AI coming into full force, it's already threatening jobs. Now, I don't want to sound doomy and gloomy, but what it means is that as AI will transform the workforce, which is like the estimated 7.2 million Australians could transform their work, their work could be transformed. At this point of time, there is still a way on how you can protect your income, and that's why I'm building a business. Right, business gives you control. However, it's not an easy gig, and that's why we see a lot of financial experts, they give the advice of going down that path of buying property or gold and shares and Bitcoin. And I'm not saying that's not a right thing. Again, these are all valuable assets. It's just that building a business is, in my opinion, by far the best investment because it gives you better control. And as long as you're operating within your sphere of competence, you can take the revenues and your income from point A to point B, and and then it depends on you whether you want a lifestyle business or you want to grow and become corporate. But the skill set is definitely needed. So I think with this AI, when it comes to change and disrupt, and this is already happening right now, when the disruptions even at a bigger scale, business is something that we can still revert to. Now, at the same time, there was a report done by PricewaterhouseCoopers in 2025. What they're saying is that AI exposed businesses are seeing higher revenue per employee, and productivity gains are nearly 4 times higher in AI heavy sectors. I'm happy to attach that report as well. What this means is that where the growth of the property market depends on its cycle, the growth of the business really depends on our skills, on how the experience that we've got in our sphere of competence, and B, how do I leverage AI to sell to even bigger market, whether it's consulting or whether it's your product. And yeah, that's why I think building a business right now in this day and age of AI is the right thing to do.
Look, you mentioned a couple of things there that probably, if I'm listening to you, they're going to jump out at me. First one is lenders fear lending to business acquisitions because they're concerned that business owners don't have skills to run a business effectively. I think that's a very big issue, and of course, that's why the Business Behind Your Business podcast is here to actually help business owners have the skills, get access to the knowledge to help them grow and run their business efficiently, effectively, and profitably in the long term. That seems to be a barrier to getting finance to buy businesses. And I think the second thing is we've come from this idea that that stigma that property shares, passive investments is the way to go, but the potential with a business for growing wealth and then what you do with that wealth is I guess, only as limited as your thinking and the opportunities you're prepared to embrace.
Absolutely. So just touching on that point first, like when it comes down to the banks lending out for business acquisitions, one of the key things, what they look for is your management experience. So to put it in simple words, someone who's working in the management, like in a big company, and you want to go out and buy a franchise business, let's say selling burgers. That can still happen because, there's an asset, which is a business generating an income, and the bank will look at like the profit and loss and everything. But the first question they're going to ask is, what's your sphere of competence? Or do you know how to manage the stock levels? What about the rostering? What about HR issues? What about insurance and compliance issues? So all those things are required. Compare this example with another example where someone's operating as a cabinet maker. He knows exactly how the business works. He knows where the target market is, and he wants to grow bigger. After 3 years of operations, profitable operations, he goes out and takes on business from someone who's looking to retire and enjoy life because he is at a certain age. This cabinet maker has got far better chance of making this business acquisition work and be successful compared to someone else who is new to the industry. So there is a certain skill set that is required for operating a business, and that is something banks are really big on. Yeah, so I think that sometimes people underestimate, all these issues. They say, well, I've worked in customer service and I can surely handle another franchise operation. Well, it's not that easy.
Yeah, we're looking at some transferable skills there. And I think one of the things that we've discovered through a lot of the conversations we've had here is that the skill set that you have through a corporate environment doesn't necessarily translate to a small, mid-sized business. And part of that reason is that as in that corporate culture, you're often used to having teams at your disposal, different departments, different skill sets. But you move into that small, medium business, you are, I guess, where the buck stops. You're the point of contact. You need to either acquire those skills or actually connect with the right people. And if I'm a lender, I'm thinking, well, hang on, you've left this skill set here. You've moved into this environment. There's a disconnect between your skill set and what's required to run a business. I'm possibly going to be looking at, what is the business that you're actually buying? Who is there? What's the structure? Do you have management that is being retained by the business, or are you buying a business where all the knowledge and operations are leaving because it's all up in the head of the owner?
Absolutely. That is such a crucial point, Paul. Time and again, when we present a deal to the bank, they'll often come back and say, if there is a revenue, let's say of $100, for example, why do we believe that these $100 will still remain in 26, 27, 28? And if it's just like foot traffic, we know that COVID has proven that wrong. We know market cycles, tightening of the interest rates, all those things have got an effect. But if you compare like a business model which is really vulnerable to many economic cycles and other factors compared to something or a system that is operating electronically and there is a person behind who's got a wider reach to the audience, that business will always win. These are not the skills that are taught in the schools or in the corporate environment, generally speaking. And I can say, like from my example, again, when I started the business, I was a mechanic. I knew how a loan would get approved. But when I started my own business, the first thing that I learned was sales is the engine room for any business, right? And these are not the skills that I learned at the bank. So it's a very different skill set again, as you mentioned there.
Yeah, so you've come from that corporate bank environment where you're used to the mechanics of how to approve a loan and what you're looking for. But then to actually go into your own business and start winning customers, winning business, and then helping them take their needs and convert that to financial product or receipt of that financial product. There's a skill set there that you needed to learn. And you don't, as you mentioned, you don't get taught that at school. You don't get taught that at university. And in a lot of cases, if you're doing mechanical, you're a doer, they're not going to invest in you learning skills to be somebody that grows the business. So there's a disconnect there. Just on that, so you've gone in your situation, you've moved from a role in corporate, you started your own business, and you've then had to acquire skills or develop skills. How would it be like, if I'm looking at lending to you, I'm going to say, well, hang on, there's a big risk there because I don't know that you're going to develop those skills well enough to make the sale. So I'm not going to lend to you. But let's say instead of you creating that business from scratch, that you actually, instead of building that business, you then went and said, right, there's an existing business. I've got skills that will help me run that business, but the skills that I'm missing are there with the key personnel. If I buy that business, I'm going to be able to hit the ground running faster. I've already got systems, processes in place. I've got the knowledge. I've got skill set. I can get cash flow going quicker. Is that going to make it more attractive to a lender to say, yes, we'll finance the acquisition of that business?
Yes and no. I think what makes an easy yes for a lender in any acquisition deal is to first assess your management experience. So, for example, I'm in the finance area, you're an accountant, and let's say you go and get an accounting book as an acquisition thing to add to your revenue for the business. Obviously, the lender is going to say, yes, you know what you're doing. You've been doing it for a good amount of time. So this looks like a logical decision for us. But when people, every now and then we get people, those who chase the profit figures only, and they think that they can leave their corporate jobs and then start a business or acquire a business to just make more money. That rarely happens. And I've seen the best of the C-suite executives sometimes, starting their own business and not being able to make it because starting a business and growing from the very base is very hard. It's not everyone's cup of tea. And B, let's say if you take on a business that is already running and you don't have that business mindset, if you're still operating from an employee mindset, it's very easy to crash things and, fall on the face.
So that management skill set is something that's being looked for And I guess the challenge is sort of that chicken and the egg. Well, okay, I need the management experience so the bank will have confidence in me and lend to me, but I can't get the management experience until I actually am working in a business environment where I can learn from that. How do I get to that position? So there are some challenges there.
Yeah, yeah. I mean, one can make a transition in two possible ways. The way I did it was I was working full time as an employee within the bank. Then I switched my role where I was a subcontractor, still getting paid by another company, but I was going out and creating my own database and my sales effectively in the market. So it came to a point during COVID, my inquiries just went through the roof, and it was very hard for me to keep on getting more inquiries from my own channel and still keep on operating as an employee. So I said goodbye to the company, and it was a very amicable separation. And they understood, well, yeah, that's what happens, and started on my own. So that was like a soft transition. Or if you really are confident that you know the sales cycle for any business, you can just acquire a business because, look, acquisitions are going to provide you with an instant revenue base, customer base, trained staff, and there's a pricing that is tested in the market. Now, a lot of owners really underestimate, Paul. I mean, we've come through so many scenarios where they underestimate how long it takes to replace staff, customers, and systems. I think that's something it shouldn't be taken lightly.
Yeah, I think we have a misguided view on things like replacement of key staff and then onboarding of new employees. If you don't have those systems and processes correct, it's going to take a lot of disruption. And what tends to happen in that particularly in small business where you have limited numbers of employees, limited team numbers, you end up having to jump in and fix, be that stopgap and do that skill for a particular time period. And look, if you don't have that skill, you're going to be found wanting. So there are a few issues there, but you mentioned some key things there about an existing revenue streaming, known pricing, known systems and processes. What are some of the things that banks will say, well, hang on, these are things we're looking for and give us confidence if we're going to lend to you to buy a business, to acquire a new business?
Yeah, so from a bank's perspective, I think the main thing is how stable is the revenue and how stable is the owner of the business who has been running this. What's the brand that a business commands in the market? So we've seen deals ranging from restaurant acquisitions to acquisitions of $15 million businesses, whereas a commercial painting shop, they've just got the key commercial accounts up to provide paints, and these are highly profitable businesses and it's a niche in the market, like specialty paints. So what we have seen is that the banks look for the brand name, the a predictable revenue stream, and like any sort of key risk that might appear. This could be a compliance risk, or this could be a technology risk. In addition to what the bank sees, from my experience, I would add, I think it's very important to see who is the key person running the business. As let's say, if I've worked in a commercial painting business for more than 10, 15 years, and I've got that brand out that I can go and get some key contacts, some key accounts from day one, that is my strength. Um, that can be plugged into a ready-made system that I'm acquiring, and then the business acquisition is a great thing. And if I don't have that ability and I'm solely relying on my existing database, one thing from my experience we've seen is that anytime a new owner steps into a business that is acquired, there will be some sort of adjustment on the sales because either the existing clients are not going to like you, or you're not going to like those clients, and there will be a drop off from the existing clients, which will shrink your revenue, and we see that very often.
Is there any like sort of standard or regular figure that you should allow for that? So maybe like expect revenue to drop by 15 to 20%, or what are some of the danger signs that you need to take into account?
Yeah, so most of the banks, they would adjust your forecasted figures by 10%, 5 to 10%. But I think a safe zone, what we have, if I was doing my own forecasting, I would definitely take 15 to 20% in my revenue as a drop off figure, and then see how far can I survive on the 80% revenue. Can I still pay my bills and staff and systems? Can I still add on technology to get things easier? So those are extra layer of considerations I would put it on.
Yeah. Look, I was having this conversation, I think, only just yesterday with a client. We were joking about the fact that forecasts provided for a bank to support a lending acquisition are never bad. They're never unfavourable. They're always the best picture. But I think you touched on it with your forecast. You need to take into account that drop of 10% or maybe even 20%. I know that my approach when I'm creating forecasts with clients is we have the picture of what we think is achievable, what will happen, and then we factor in a drop of, say, maybe, well, what happens if our sales are 15 to 20% less than what we expect? Can we still pay all our overheads? Can we still cover our wages costs? What's our cash flow going to be like? Do we need to inject more funds at this point, or how are we actually going to then, if sales drop in this period, what plans do we need to put in place to reverse that trend and actually start growing after 6 months? But I think a lot of people just think the best case scenario, I've got this business, so I'm going to immediately, as soon as I step in, it's going to grow 20% because I'm fantastic.
That really happens.
Look, I think there is that timing there. So the banks are factoring that in, and that's a really important thing to do. How much preparation would you suggest somebody that's looking to acquire businesses should start doing?
Yeah, great question. I think in the corporate world and even at the elementary school level, we are being trained to do everything by ourselves. So the first thing I always, tell people, anyone who's looking to acquire a business, is to have a good team. For you to have a full assessment on what are you stepping into. What does this team look like? A team looks like a good accountant, a good lawyer, and a good finance consultant. This is the first step for anyone. Show your financials, give out your plans, have a word with them as to what are your real plans. Let's say you come into the business, are you going to be running this business as it is for the next 2 years, or do you have plans to bring in technology? Have you got an app that might just increase your visibility or retain more clients? Those are the things one should start at with. And team part is really important. Without a team, what we're seeing is that the failure rate is just through the roof. When someone's got a proper guidance around these factors, because these are not easy things to navigate, they are very complex matters. And only a seasoned person who has been in the market, who's helped someone else go through this phase, they are the people you should be talking to as a business owner.
I think certainly you mentioned that team, accountants, lawyers, and finance, and I think you need to have your team working together. Where those individuals work in a disconnected process, you miss out because the accountant's giving you one set of advice, but they're not taking into account the legal considerations, which would, if they did, they'd change some of the assumptions and thoughts about the forecast and the profitability of the business you're reviewing. So your team needs to work together, and they need to all be on the same page. So don't have them working in silos, have them working together. It's really important. Look, we read a bit Prophet of Doom in sort of like talking about some of the negatives and the red flags. We started talking about why business acquisition is actually a great way to grow wealth. I just want to raise a couple of things with you there, Sidd. I've actually been on the side advising buyers of businesses, so doing the work, pre-work, so reviewing forecasts, doing what we call a due diligence review. I've actually uncovered multiple times, probably a bit scary how many times I've uncovered it, but the existing owner of the business is leaving money on the table. They haven't got their business working the way that it could. There's a lot of opportunity there. So, does that come into play? What happens if we get a business, we've reviewed it, we say, right, here are the opportunities where we can add value to it. Does that have any weighting when you go to the bank?
Yeah, and I think one of the reasons, and you're so right, Paul, people just leave money on the table, and one of the primary reasons I've seen is because people don't see business as their investment, especially in Australia where we see property as an investment and other asset classes. I think when it comes down to the businesses, we rely on stock and other things as a key thing that we can sell rather than the systems or technology or even like your own experience. Because let's be honest, what brings in the most money in the business? It's your brand, it's your reach to the people. So this is the key asset. So do we really know our business's worth in getting more people? And are we really effectively taking that amount or value to the market? That is of key importance. And that's why, again, goes back to the point, we need to have a strong team who can guide you. Also, I see, sorry, your question was like in terms of value, right?
Yeah, I think that there's like I often see missed opportunities from a seller. They've missed opportunities to grow their business. They've missed profit streams, and when we're looking at it for the buyer, we've actually looked at it and said, right, okay, the value is low, but there are these opportunities exist with this business that might add value or can add this kind of value to it. Is that something that a bank will consider when they're considering your application for finance?
Yeah, 100%. So banks will, there is something called an EBITDA, and without getting too technical, like it's just the profit that the business is generating after all the expenses. So that's the money that you take home. So EBITDA has to be a certain multiple. Generally, the business you will see that they get sold for 2 to 5x earnings, and what we've also seen is that the smaller the revenue size, the smaller is the multiple. As you start growing in revenue, the multiple starts growing. So let's say if it's a post office generating $100 in profit at the end of the year, and the post office owner is asking for $1,000 as the business acquisition price, which is 10x my EBITDA, it would be very hard to sell that story to the bank. So, or we can break it down to say, is that 10x figure the right valuation for the business, right? Who decides the right valuation? So the banks have got a certain formula. They need to have like 2.5 times or 3.5 times the EBITDA figure to the loan. But also there are other examples that we have seen contrary to the first one, where people have got great business and they're just selling their business for 3.5 times the multiple. So for example, I'll give you another restaurant operation in Melbourne who was selling this business for 3.5 times. Now, generally speaking, these sort of businesses would go to 2 and 3x because restaurants will only rely on the footfall. However, this particular gentleman, he had this ability to attract all these great quality chefs who would come once a week into the restaurant and would do a cooking class, and they would just amaze the whole floor. Generally, it would be Friday night or the weekend. And that's the brand of the business. So it's a well-known, respected brand. So when we worked out with the accountant, we found out, well, you can charge more because look at your revenue growth for the last 3 years. Now, this clearly goes into the multiple story. Now, when you show that strong growth to the bank, banks are more likely to go ahead and say, okay, well, that makes sense. Well, 3.5 times for a regular business versus 6 times for this special business that can attract a lot of customers. It's proven in the past, and that's what's going to continue because it's not founder dependent. Yeah, that makes sense. So these are little things that the banks would see, and a business owner should look into this as well.
Yeah. So bringing it all together, we've got significant opportunities with acquiring businesses, but you do need to do your homework, you do need to prepare, and you do need to have the right team at your disposal working together and really understanding the value that you create, the gaps, and addressing that. Have realistic forecasts. Don't overinflate the value that you're going to add because there's going to be a drop in that value straight away. Make sure that you don't rush through the process. Do every step. Make sure that you've got somebody like Sidd on your team who is experienced in actually finding and helping you acquire finance for business acquisitions. Not every financier is going to have that skill. So make sure that you can touch base with Sidd or somebody similar who has the skill in business funding, because it is a difference. It's a different skill set, and you want to be dealing with the right people with the right expertise to give you the best start. Look, there's a lot of opportunity there, Sidd. If somebody was looking to get your help and get started on this journey, how would they get in contact with you?
Yeah, so my email address is sidd, SIDD, @expressfinance.com.au. Otherwise, someone can just visit our website and drop in a query. It'll come straight to my team, and we'll be very happy to have a conversation. So otherwise, we are regularly out there in the expos as well. We're happy to provide my contact details, which is 0404801783. That's my contact number. So very happy to help. Yeah, but I would, if I can just add one last thing, Paul. In this world of AI, I think it's an incredible opportunity where AI is just adding to these multiples where a business can be sold at higher multiples, because AI is just making things so easier, or the reach to the wider world so much easier. So I think it's incredible times that we are living in.
Well, that's great. So thanks. So you've unlocked a bit about how we can actually use businesses to grow our wealth, grow our value, and the opportunities that exist. Looking forward to that. If you're listening to this and you're thinking, well, there's some things that we can do here, things to get started, maybe it's a case of you've heard this conversation today and you actually need to go and change some things in the way you run your business. That's a great place to be, because what we want to do is make sure that you've got the best business you can. Take a hard look at how you're going. Get the skill set, get the right team, like Sidd said, get the right team involved and working together to grow your business and give you the best opportunities you can. Sidd, it's been a pleasure having you on the Business Behind Your Business podcast. And listeners, as always, the links to the material that we've mentioned and how to get in contact with Sidd will be in the show notes and also on the businessbehindyourbusiness.com website.
Thank you, Paul. Appreciate it.
That's a wrap for this episode of The Business Behind Your Business. We hope you found today's discussion insightful and valuable for your business journey. Before we go, don't forget to subscribe to our podcast on your favourite platform. Share it with fellow business owners who could benefit, and send in your burning questions, because we love hearing from you. Missed any of our previous episodes or looking for additional resources to help grow your business? Head over to our website at thebusinessbehindyourbusiness.com. There you'll find our full archive of past episodes, along with show notes, transcripts, and links to valuable resources mentioned in each episode. Your journey to business success continues at thebusinessbehindyourbusiness.com. Until next time, stay inspired, stay informed, and keep building the business of your dreams.